Going on, ladies and gentlemen, we have some interesting news. Former quantitative researcher for Citadel Securities is now absolutely railing them for lying about lit markets, for lying about IEX, basically doing everything they can to maximize their market share and make sure that nobody can try to take that away from them, as expected, right? This is nothing new. A lot of people have been expecting this for a long time. Going on, Gummy? SAS, great to see you, ladies and gentlemen. Welcome back. And I agree with you in the comments. He is absolutely correct in the chat. Yeah, let me know what you guys think down in the chat, and let's discuss this. Because Dave Lauer, again, former Citadel Quant, he's a former quantitative researcher for them, said PFOF brokers and wholesalers do not represent individual investors. IEX Investors Exchange, which is a lit market, has filed for a new options exchange, and the usual suspects are out with the same exact arguments that they used 10 years ago against the equities exchange when it first tried launching, of course. And for those of you that don't know, you currently can buy shares of stock if your brokerage routes to IEX. Of course, Litxchange will be routing to IEX and other lit markets and lit exchanges. Dave goes on to say, they, talking about Citadel, were wrong then, and they are wrong now. And I wrote a comment letter. So let me explain. His comment letter starts off by saying, before getting too deep into this comment letter, let me state unequivocally that over the arc of my career, what I've observed is that PFOF brokers and wholesalers do not represent individual investors' interests. Individual investors are not their customers. These investors do not pay them money for a service. Instead, these firms, talking about Citadel and Virtue and so on, monetize individual investors and their order flow, and it is their interest in monetization that they represent. And he's talking about payment for order flow brokers like Robinhood, Charles Schwab, Webull, even Fidelity uses payment for order flow from these price distorting dark pools. Instead, these firms monetize individual investors and their order flow, and it is in their interest in monetization that they represent. Any statements suggesting the contrary in comment letters should be seen for what it is: an obvious and repeated sleight of hand meant to distract from the fact that these firms are worried about losing market share with a more even playing field. Citadel continues to lie about IEX's new options exchange in the same way that they lied about IEX's stock market exchange for shares of stock 10 years ago. They're terrified that upcoming brokerages like Litxchange will route orders to IEX, avoid dark pools, and cut out the middleman, Citadel and Virtue, so that they can no longer internalize trades, so that they can no longer process orders in dark pools, so that they can no longer fail to deliver on those, and so that they can no longer create synthetic shares, meaning selling shares of stock that they don't have via legalized naked shorting. You understand? It's really that simple. I have my chat box turned off. I'm not sure exactly how to turn it back on right now, but that's not really a huge deal. My apologies, ladies and gentlemen. You can still see the chat down below, even though it's not directly below my picture. But check this out. At Litxchange says, we're coming to empower retail, expose market manipulation, and give investors tools that Wall Street never wanted them to have. While other brokerages are restricting trades, we're building our platform around freedom and transparency. No dark pools, no bullshit. Dave Lauer continued with his letter, and it was scathing. And he sent this to the Securities and Exchanges Commission, in case you guys are unaware, in an open letter. In 2016, Citadel told the SEC that approval of IEX Equities Exchange and pegged order types would, quote, weaken the displayed market, increase transaction costs for all investors, and ultimately increase the cost of capital and reduce employment and job creation, end quote. No, seriously, they said that, Dave continues. Seriously, that's not something that AI hallucinated. That's an actual quote from Citadel. Take a minute and go jump to the end of the comment letter in the footnote if you don't believe me. It's real. Obviously, that was not only absurd, but also proved to be inaccurate and patently untrue. The absurdity existed at the time that they wrote in the comment letter, yet they still filed it, and it continues to exist today. The same is true across the board for critics of IEX equities and options then and now. Their comment letters are filled with sweeping statements, claims that they represent the investors whose order flow they monetize, and a complete lack of evidence or data. The commission should see these comment letters for what they are: evidenceless assertions meant to preserve incumbency and market share, and nothing more. The commission should evaluate the IEX proposal on its merits, just like they did in 2016 when they approved the original IEX exchange for stock shares, and approve this innovative market model. As you can see there from the comments, I completely agree. You said it, Dave. PFOF brokers and dark pool abusing market makers do not represent retail. They profit when retail loses. And that's a fact.
Bro, what happened? I was rich, but then my brokerage restricted trading and I lost it all.
It's time for change. Litxchange. No dark pools, no restrictions,
no bullshit. Check it out. You guys can catch us on Morningstar, Yahoo Finance, many other platforms, Market Watch, etc. And so far, we continue. We've ratioed Vlad Tenev of Robinhood before, and we will do it again. We've ratioed Citadel, and we will do it again, without question. Dave also said that instead of dismissing these criticisms as evidenceless hypocrisy, which is what the exact firms do in their comment letters, for example, that IEX will, quote, enrich its shareholders and its select cadre of market makers, all at the expense of millions of American investors, end quote. Let's examine the evidence provided by these critics. This is instructive because, again, critics of IEX options are using arguments in their comment letters that are identical to those used against the IEX equities exchange 10 years ago. Presumably, these firms would have used those criticisms from 9 years ago to boost their fortune-telling talents. And he goes on to show 1, 2, and 3, and there's nothing there. I can't find any. That's pretty weird. One would think that they would be awfully proud of their ability to forecast these trends, and that this data would bolster their arguments against IEX options. Joking aside, these critical comment letters lack any empirical evidence because there is none to support the statements that they have made, and in fact, there's ample evidence that refutes such claims. And I went ahead and posted this on multiple different platforms, including Superstonk and AMC and such. So far, getting over 250,000 views, did extremely well. And we got some really good questions here that I'd like to answer, that tell you guys briefly, in case you guys are wondering. Fragrant EBB says, Boss Blunts is the one trying to raise $1 million for Litxchange. And Dave used the likeness of his community to push We the Investors, and can only imagine he's also attached to profiting from Litxchange app. He spelled it wrong and obviously knows nothing about Litxchange app, but I'll continue. He said, just another example of people riding this community for their own gain. People are going to say this is good for us and the market, but it doesn't change anything. They just won't use this exchange, assuming this exchange even has an impact. And what the actual fuck? Is this not the quintessential definition of self-monetization? So I went ahead and responded to him. There is no partnership, funds, or interest whatsoever between myself and Dave Lauer, regardless of how much you'd like to believe that. I've been invested in GME, in GameStop, stock since January of 2021 and hold a vast amount of GME. Unlike yourself, I prefer to use my skills as a lifelong entrepreneur and business owner to help people by creating change where it's most needed. There will always be people such as yourself that believes that no one could ever do anything to help retail because you're so jaded by those that have harmed us. But you don't know anything about me except for your make-believe assumptions. If you don't or can't understand how routing orders directly to lit markets like IEX would help retail investors and divert shares away from dark pools, then there's absolutely nothing that anyone could do to help you see reality. Brokers aren't required to accept payment for order flow from wholesalers like Citadel or Virtue. You understand? There's no requirement saying that you have to accept PFOF from Citadel or Virtue. They choose to. But why? It's because it pays them a lot of money. Litxchange doesn't need your money. Please do with it what you will. The company will succeed with or without you. I've spent millions of dollars of my own cash in the last 4 years of my life, as well as my partner Mehul Patel, in order to get this company off the ground. We've invested the last 4 years of our lives into this company, and we'll be investing the rest of our lives into it as well. In the future, you'll likely look back on this post and regret it, but that's okay. Best of luck and Godspeed. Can't stop, won't fucking stop. Of course, the majority of people were very responsive to that and very happy to see it in comparison to his quite ridiculous assumptions that make an ass out of him. So Multi-Mike asked a really good question. Why would my broker use IEX? What brokers use IEX? Is trading on them as easy, for example, as Wealthsimple? And I had to explain that naturally this is a good question. So I was happy to explain that IEX is not a brokerage, right? They're an exchange, such as the New York Stock Exchange, the NASDAQ, etc. They facilitate the sale, the actual transfer of individual shares from the seller to the buyer that is routed to them by the brokerage. Most brokers like Robinhood, Schwab, Webull, etc. make billions of dollars off payment for order flow, in which the market maker pays them cash in order to buy your order. So the market maker, Citadel, Virtue, etc., can then front run your trade, internalize it in their own dark pools, and issue synthetic shares out of thin air, thus artificially diluting the company's stock. And what does that happen? What happens to the stock price? It goes down. They can then fail to deliver and kick that can down the road for ages. Basically, they're making money when you lose money. It's really that simple. That's why they can afford to pay more than the NASDAQ, the NYSE, and IEX in rebates, because firms like Citadel and Virtue can do these things to maximize their profits and minimize yours. Companies like Litxchange, for example, that would avoid the payment for order flow from said wholesalers and dark pool abusing market makers would route orders directly to lit markets. Doesn't this make less money for the brokerage? Yes, but money isn't everything. Okay, the brokers still get paid a rebate from the lit exchanges, such as the New York Stock Exchange, NASDAQ, IEX, etc. It's just less money than Citadel or Virtue pays for your order. Citadel and Virtue can pay more because they can front run trades, abuse your shares, FTD, create synthetics, sell your shares short, naked shorting, etc., so that they profit and you don't. Doing so as a market maker is legal, by the way, folks. That's the big problem. It's called the Market Maker Exemption Rule 203BI, right? It's also known as the Ponzi King himself, the Bernie Madoff exception. But that's where integrity comes into the mix. Not everything in the world revolves around maximizing profits. It's more important for Litxchange and myself to create value for customers and shareholders by routing orders to lit markets, preventing synthetic share creation, failures to deliver, front running of your order, hidden fees, and much more. Educated retail investors understand, appreciate, and value this the most. In the long term, people will love that they're not being manipulated, that they're not being abused in dark pools. And because we have learned a lot since 2008. I've been in the markets since before 2008 GFC. We've been through this not once, not twice, but multiple times, folks. And people know better. And those that don't are being educated by their friends and family. Period. For example, look at AMC Entertainment Holdings on Fintel. The short interest ratio is now at 32.2 days to cover. 32 days to cover with a 14.5% short interest. Percentage of the float shorted, 62.6 million shares sold short. That we know about. That doesn't even include all of the synthetic shares, the failures to deliver, the married and divorced puts and calls, all of the swaps that we have no idea where they are because they are hidden and traded between desks. That's the big criminality there between ISDA swaps. And the shorts marked as long because these guys can actually cook the books. Citadel and others, many others, Goldman Sachs, Citadel, Bank of America, etc., have all been fined millions of dollars for marking shorts as long. That, again, is the definition of cooking the books. It's taking a liability and mismarking it as an asset. And I'm not talking about a few. I'm talking about tens of billions of orders, underlying hundreds of billions of shares, if not trillions of shares underlying in which they lied about. Trillions, folks, with a fucking T. Days to cover, in case you don't know, tells you how many trading days it would take for all the short sellers to buy back their shares, meaning cover their positions, assuming the average volume. This means extremely high short interest or very low trading volume. In this case, it's both. It would take over a month of average trading activity for all shorts to exit. This is massive because there is short squeeze potential. If buyers push up the price fast, short sellers rush to cover. That's a huge wall of buying pressure trying to exit through a tiny door. And it is a perfect storm where prices can skyrocket in a short squeeze, folks. 32 days to cover. Extremely illiquid short positions. And explosive squeeze potential. The higher the number, the harder it is for shorts to escape without causing a price. Keith Shortseller brings up a great point. He's like, the math ain't mathing. It's more like around 9 days. I'm like, well, it's based on short interest and volume, sir, because a lot of these companies, they use different mathematical probabilities here and different ways of explaining this. He brings up a great point. Yeah, if you compare it to the short interest divided by the average daily volume, that is 5.98 days. That's about 6 days to cover. But Fintel calculates the shares available to borrow or trade. Fintel calculates it against the shares available to borrow or trade, which is 2 million shares, hence 32 days to cover. So it's not a mistake. It's just using a different lens. It's looking at it because we've had an average daily volume of around 2 million shares over the last 5 days. Therefore, we're looking at about 32 days to actually cover. Covering that much short interest would take about a month, a setup ripe for massive squeeze in liquidity conditions. And so again, because it's calculated based on the most recent 5 days of trading volume, and that was historically low at basically all-time lows, as a lot of orders are being suppressed, withheld, and being processed in dark pools. These market makers like Citadel and Virtue, they can hold on to your trades for up to about 28 days, I believe, without even doing anything with them. They just give you fake ones and zeros in your account. That's a big part of the problem with synthetic shares. And then if they don't deliver it, well, it's a failure to deliver. They can kick that can down the road almost in perpetuity, almost infinitely, by transferring the shares through wash trades from one firm to the next. Tanel, Captain Awesome, Nicholas, great to see you, ladies and gentlemen. But I think I've made my point here. AMC Diamond, bringing my 10,000 AMC shares over there for sure, and we will see you and everybody else there as well. Now, I'd like to ask you guys a question. Who would like to see the total number of AMC shares held by all Litxchange users? Litxchange is slated for release in 2026, folks, and we plan to provide the total number of shares of heavily shorted equities like AMC, GameStop, Tesla, etc., held by users within our upcoming stock and crypto brokerage firm on a regular basis, meaning that you will be able to see how many shares of AMC stock, of GameStop, of FNGR, of GNS, of QNTM, etc., are held by all of the Litxchange customers within our brokerage alone. You can then use that data to extrapolate across other brokerages to get a better idea of just how many shares are out there versus how many shares should actually exist for that company. I hope that everybody understands just how massive that is. And you guys need to let me know if you have any questions. I will be glad to answer them down in the comments, all right? Thank you very much. Ladies and gentlemen, have a great rest of your day. Make sure you go to litxchange.com. The Regulation C under the Jobs Act of 2012 Founders Program campaign ends August 9th. So August 8th is the last day in which you have to have everything subscribed if you would like to get the equity, the shares, the perks, and everything else involved in becoming an owner and partner in Litxchange prior to the company's launch and IPO. This is a once-in-a-lifetime opportunity. No other upcoming stock and crypto brokerage firm has ever given you or anybody else that is not an accredited investor the opportunity to invest in the company prior to launch and IPO. Cheers, folks. I wish you peace and wealth. Have a great rest of your day. Thank you. Turkey continues buying. I have a feeling a lot of people do. Good luck all.